Coming up on the SBS On the Money podcast, we take a look at the spring selling season hotspots. Investors look to the US Federal Reserve, and we take a closer look at the reporting season that was. All of that and more next. Hi everyone, welcome to the SBS On the Money podcast for this Monday, the 1st of September 2025. It's a day where the Australian share market fell, the S&P ASX 200 down 0.5%. We'll have the details with Mathan Somasundaram from Deep Data Analytics in a few moments. But first, a combination of lower interest rates and limited supply, seeing prices in the housing sector continue to rise, although affordability constraints are keeping a lid on growth. Cotality says the median national value climbed 0.7% in August to almost $850,000, and that's the strongest gain since May last year. Perth, Darwin and Brisbane did best, up by at least 1% each last month, where there is low advertised stock levels, and Hobart was the only one to decline. Meanwhile, the gap between Sydney and Melbourne continues to expand, a difference of more than $400,000 in the median price there between Australia's two biggest housing markets. So for more, I spoke with the head of research at Cotality, Tim Lawless. Tim, how would you describe the pace of home price growth last month and what's driving it?
Well, a 0.7% growth over the month, Ricardo, it's definitely a step up from where it was at the end of last year or before rate cuts, but it's definitely not shooting the lights out. I mean, this is the strongest rate of growth we've seen since May last year, to provide some context, but it's nowhere near the sort of levels we were seeing through the pandemic when monthly growth was up around 3% for a little while, or early 23 when growth rates were sort of up around the mid ones. So it's stronger, but arguably a lot more sustainable than what we've seen through previous upswings.
Brisbane, Perth and Darwin grew the most last month, all at or above 1%. What are the common themes here?
Yeah, I think, well, they're all running at different speeds, and there's a few different factors, but the commonality amongst those three cities is they have really low advertised stock levels. I mean, Darwin is tracking about 50% below their 5-year average for the number of listings in the market at the end of August. Perth's down about 40%, Brisbane's down about 30%. So there is a real disconnect between supply and demand in those markets. They've also got generally strong levels of investment activity. And at least for Brisbane and Perth, these are markets that have a real, recent track record of strong performance. It's very much been the mid-sized capitals that have dominated the growth trends over the past couple of years.
So overall, though, do you think it's a function of interest rates coming down now 3 times from the RBA, more so than level of stock availability, or do you think it's that lack of availability that's driving up prices?
Well, it's definitely both, and there's a few other things as well. I mean, there's no surprise that we saw this positive inflection in housing markets from February, aligning with the first rate cut. But also this, I mean, that's clearly spurring demand. It's improving borrowing capacity. It's boosted confidence. But that pickup in demand is just running headlong into very low levels of supply, both immediate supply in terms of how much stock is being advertised for sale, but also just the number of homes that are being built clearly isn't keeping up to pace with the track record of population growth we've had, or for that matter, the aspirational target of building 1.2 million homes by the middle of 2029. That's looking increasingly difficult to achieve that objective.
It's a good day to release this report, the first day of spring, right? So we're heading into the spring selling season. Typically, it's the busiest time of the year. What are you expecting?
Well, I think it's going to be a very active spring season, Ricardo. Like I said, we're starting the spring season from a really low base in terms of advertised supply levels. So we should expect that vendors are going to become more active. We should see a real ramp up in the number of new listings coming to market. That's great news for buyers because they're kind of starved for choice at the moment. But my guess is demand is going to pick up as well. We might see another rate cut towards the end of the year. We're likely to see a further pickup in confidence. We've got the expanded first home buyer deposit guarantee in the wings from the 1st of October as well. All these things are demand side factors that are likely to see more buyers in the market competing for what I'm guessing is going to be an insufficient level of listings, which ultimately is going to be pushing prices higher.
So it sounds like the seller will hold that balance of power, right?
I think so. I think most markets we're looking at are seeing listings well below average. Even a market like Hobart, that's generally had high levels of stock, is now below average at the beginning of spring. So, yeah, wherever you look, supply is looking pretty tight.
So what's your advice then for buyers and sellers going into this spring?
Well, yeah, it's pretty tempting to rush into the market. I believe that a lot of buyers are probably feeling this sense of urgency to buy before prices rise further, or somebody buys a home out from under them that they're looking at. So buyers probably can't negotiate all that much, unfortunately. Homes are selling pretty quickly. Clearance rates are up around 70% and rising. So the reality is it's a seller's market, and buyers probably don't have a great deal of time to deliberate or negotiate on prices. But the advice I give to buyers is, I mean, you got to stick to your budget. It's definitely not the sort of market where you really want to stretch yourselves too thinly.
And finally, for those that are looking and keen to buy, where do you see the hotspots for investors where they can see value but still see opportunity for growth?
Well, I think it's becoming harder and harder, to be honest, Ricardo. I mean, values, fair enough, they're rising everywhere, but prices are pretty high everywhere as well. One market that really stands out for me is Melbourne. You know, Melbourne, even just last month, values were only up 0.2%. It's still a pretty mild rate of growth. We haven't seen a gap between Sydney and Melbourne prices this wide since about 1999, so it looks quite undervalued, at least in relativity to Sydney, and yields are a bit higher as well. So I think for the medium to long-term growth prospects, Melbourne looks pretty solid to me. The more immediate growth is pretty clearly in the mid-sized capitals in Darwin at the moment.
That's Tim Lawless there from Cotality. Let's take a closer look at the Australian share market now. The S&P ASX 200 down 0.5% to 8,927. 7 of 11 sectors were lower today. IT, the worst performing sector, followed by consumer discretionary, the best performing telecommunications and consumer staples. The best and worst stocks, if we take a look at the best stocks first of all, Capricorn Metals up by 11%, followed by Genesis Metals up by 10.5%, and Harvey Norman also extending on the gain seen last week, up 8% today. The worst performing Perpetual Limited down 6%, Mesoblaster off by 7%, and Generation Developments off by 8%, the worst performer on the 200 today. For more on the day's market moves and for a look ahead at the Fed Reserve meeting later this month, I spoke with Mathan Somasundaram, CEO of Deep Data Analytics. Mathan, it seems like it's a pretty subdued start to the week, given US markets will be closed tonight and reporting season is finally over. So what are investors looking out for at the moment to drive equities in the next few weeks?
Yeah, it's an interesting time. We finished our reporting season. There's a few draggers, but mostly done. So there's a bit of, I guess, consumption going on with the data. Everyone's digging through the details, trying to work out where they should be positioned after the reporting season. We had the big three stocks in our market, which lead the three of the big sectors in banks, healthcare, and mining. They didn't really shoot the lights out. They're trading at pretty high multiple, and CSO got hammered on the back of that. So in that context, there is a lack of direction at the moment. And on Friday, we had the Fed's preferred inflation measure coming. That's 3 months up in a row. It's 5-month high. So it's a bit tricky for the rate cut cycle. And then you had I guess, cancellation of the lowest cost retail that can be sent into US, where you had an $800 limit. That's now gone. So there's a bit of a hit on retail. And there was political legal challenge on the tariffs. So there's a lot of uncertainty in the market. So it is interesting that they are in a long weekend. So I think the global markets will be a bit poppy, and we'll wait and see how this all settles down.
So speaking of global markets, when you look overseas, you already mentioned the US. What about China, the trade war and implications for investors? I think there was some manufacturing data out today out of China, which showed that the sector continued to contract there. I think it's 5 months in a row now.
Yeah, China's been, I guess, I wouldn't say it's a shock. I think most people would have expected it to be relatively weak. But that's been the thematic for a while. I know for a couple of years, there's been a lot of, I guess, concepts pushed out there that we were going to get dramatic stimulus to drive growth. They went through a 3-4 year cycle to unwind their property sector, which was at the peak, was one of the biggest asset class in the world. So I don't think they're going to be hurrying to run back in. The other driver of growth for China was the Belt and Road project, where most of the other countries, emerging market countries, have huge debt issues. So they're not doing much either. So there's not a lot happening there. China has been proactively stimulating their tech sector and their consumer spending for the last couple of years. And I don't see them moving away from that. I think they'll continue to do that. That means it's only a slight stimulus. They adjust things, try and keep inflation down, try and keep the cost of living down. And they've been pretty successful in that. I don't think the trade war is anywhere near ending. I think we're just going to go from one concept to another concept, but I think it's a never-ending story. White House is a reality show. So you're just looking at social media on what's going to come out next. So in that context, China's not going to rush out and do anything, because if the US then changes to another form of attack, then they're going to be under threat. So they're going to wait. I mean, at the moment, there is not even a chat for a couple of months for the next negotiating cycle. China still holds rare earth. US can talk tough, but at the end of the day, if China squeezes that, they squeeze everything. So in that context, they do have a leverage point. So I don't think anything's going to get resolved. I think we'll just meander on. So China is weaker. I mean, the whole world is getting weaker on growth, but China's not going to have any huge issues in the short term. And I don't see them doing anything much as well. So our mining sector on the back of that is probably not going to see a lot of catalysts short term.
You mentioned earlier reporting season and went into detail about BHP, or not detail, but you mentioned BHP, CommBank and CSL. With the season finally over, what were some of the key things that you learned?
Well, the most interesting part about it is the market knew what came out. It's not really a shock, but we still got shocked anyway. we are all holding. I mean, at the moment, the global passive floor has pushed CBA to incredible multiples, right? You don't need to be a bank analyst to know that. It's paying less yield than the bonds. So the valuation is extremely expensive. We knew from all the banks, most of the other banks are also trading at near all-time high. The reality is there is no growth. The yield is not that exciting. The risk is just usual cyclical risk. So in that context, we're overpaying for banks. That's one side. And then you look at, as we discussed with China, there's no real stimulus that's going to drive bulk commodities. So where does BHP go from there? I mean, look, BHP is one of the top global miners, but I don't see a catalyst driving it a lot further. I think the result kind of put a stopping block there. CSL is the number 3, and you've seen it bounce and then get smacked down because of the downgrade and the uncertainty. I mean, if you're waiting for certainty from the US government, good luck with that. So I think CSL will struggle, but I think around here, the risk return is actually quite positive. CSL probably looks the worst. For me, out of the 3, that probably offers the best opportunity.
When you look at the US, the construction outlook in Australia and overseas, we had companies like James Hardie reporting it was smashed. There are some other issues with it entering, I think, an asset in the US as well. Reece Plumbing also, the company also surprising the market too. What do you make of those results and the outlook for construction?
Yeah, the US construction cycle is under real threat. You got one side of it, cost of living. The other side of it is US housing market is rolling over for the obvious reason that the interest rates are still quite high. Mortgage rates are near 7%. So because they have 30-year fixed rate for 95% of the people, there's actually no incentive for anyone to move. So everyone's going to sit in the houses that they have. So the problem with that is the construction cycle is running into high cost. And then you got tariffs on steel, copper, and all of that hitting it as well. And lumber. You've got war with Canada, Jesus. But don't get me started there. So you're kind of killing one of the goose that lays the golden egg. So they've kind of hurt the property market. And hence, the White House is attacking the central bank to get them to cut rates, which is kind of, you're fighting against your own argument by pushing up inflation. So the Fed is probably going to cut in September. I don't think that's a positive cut, but the biggest problem is the bond market. I don't think the bond yields are going to come down. The last time the Fed cut 3 times, 100 basis point cut in 2024, the bond yields went up 100 basis points. Now, if that happens again, you can pretty much say the Fed has lost control of the cost of borrowing. That's a scary thought. This is 1 in 50-year cycle, and we're doing the same mistake that we did in the 70s where we did double inflation cycle. Inflation is going up. We can see it everywhere. We can lie about it, but it's going up. So the question is, what is the market doing? And I think the construction cycle is going to be one of those collateral damages as interest rates remains pretty high.
Is it fair to say that the Fed meeting later this month is probably the key market moving event of the month?
Look, they don't surprise the market. US Fed hasn't since the pandemic. So the rate cut is pretty much there. The question is what happens afterwards. It's the commentary afterwards. But the problem here for me is, I mean, we got non-farm payroll coming at the end of this week. Given that the last guy who put out a bad data got fired, it would be interesting to see what comes out. Now, the inflation with PCE going up confirms what the Fed has been saying. So the question is, they will probably cut and hold a hawkish stand and say, we'll be data dependent. And if the inflation, and also we'll get the next inflation update in the US before the meeting. So if that comes against it, it's going to be fascinating because, again, everyone can say this and that, but in reality, we haven't seen this kind of cycle in 50 years. So the Fed is caught between a rock and a hard place. So, I know that this is not great for the economy because we don't know. There's a lot of uncertainty, but as a data person, this is amazing times. You're never going to get this. It's a once in a lifetime experience. As crazy as it may seem, I am actually fascinated to see how this plays out.
And so finally, how are you feeling as an investor? What are you telling your clients and where do you see the opportunities?
Oh, look, we've been bearish on the market. That's no surprise, but we've been very bullish in particular areas. We're betting on policy failures. We're betting on higher inflation. That's been our bet. We've held substantial holding in the gold sector. We continue to hold that. We have a substantial holding in the food sector. We continue to do that. I mean, food is one of those essential plays that generally runs up in the inflation cycle. We've got erratic weather in most parts of the food bowl around the world, and that's playing. I mean, if you look at beef prices here, globally it ran up, and now locally also it's running into multi-year highs. So food prices are going up, and that'll flow into all that sector. And we like energy because, you don't get an inflation cycle without energy prices. And if you're looking at AI being the future, data centers being the future, you need a hell of a lot of energy, and we don't have that.
Thanks, Mathan. Nice chat. Talk to you soon.
Will do. Bye.
See you, buddy. Bye. That's Mathan Somasundaram there from Deep Data Analytics. And that wraps up the podcast for this Monday. Don't forget, if you enjoy it, to give a rating or a review on Spotify and Apple Podcasts and to click subscribe. See you tomorrow.
This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.